Welcome to Beavers Wealth Management's May 2025 edition of Let's Talk Markets. Our goal remains clear: to educate, inform, and empower the families and businesses we serve. And so, if you find today's discussion valuable, please feel free to share it with anyone you might think will benefit from it. And so, as we begin today, let's directly address what's top of mind for most investors: the recent volatility we experienced this past month in April. And we are pleased to report that markets have significantly recovered from April's steep declines. And investor sentiment is notably improved from where it was just a month ago. Now, a significant driver behind this rebound has been meaningful progress in softening in President Trump's approach to global trade and tariffs. And so if you remember last month, we outlined three possible paths forward for tariffs. First one, Trump begins cutting deals and reducing tariffs. Second, courts or Congress intervene to limit tariffs. Or third, Trump maintains course and he fundamentally realigns global trade. And at that time, we really expected a blend of scenarios 1 and 3. Deal making alongside continued tariff implementation. And indeed, this blended approach is precisely what we've witnessed over the past month. I mean, take a look at this chart here. Negotiations have progressed positively, with allies like the United Kingdom providing substantial relief and optimism to global markets. And just this week, it was announced that the U.S. will reduce tariffs on Chinese goods from 145% to 30%, while China will lower tariffs on U.S. goods from 125% to 10%. So that chart looks a little scary on a day-to-day basis on what we were seeing from a tariff piece of it, but substantial improvement from just this Monday earlier this week. Now, Wall Street's worst fear, what was it? Well, that U.S. and China trade war would escalate further. And that's kind of eased with the announcement of this 90-day mutual tariff rollback with China. And it signals a potential de-escalation in trade tensions. Now, despite April's turbulence, there are clear positives emerging as we enter into May. Earnings remain strong. The job market continues to show impressive resilience. And inflation is steadily declining. Now, there's certainly a great deal to unpack today, and we're going to dive into all of this and more, examining exactly what's happened in the markets, why it matters to you, and what we believe investors should be paying attention to for the road ahead. Now, we truly appreciate you joining us today, and so I'm excited. Let's dive into this month's edition of Let's Talk Markets. And so we're going to start off by giving you kind of a April recap, and we're kind of looking at that month, April, as volatility and historic moves. April 2025 is a month that investors won't soon forget because it was a true roller coaster ride. It was marked by intense market swings and historic milestones. The volatility actually kicked off immediately with President Trump's announcement of sweeping tariffs on April 2nd, Liberation Day, as he said. Investors were completely caught off guard. Now, Beavers Wealth Management wasn't, but investors as a whole were, prompting a swift market reaction. You can see this, but over just 2 trading sessions, the S&P 500 plummeted nearly 10%, experiencing its sharpest 2-day drop since the COVID-19 sell-off in early 2020. And the uncertainty wasn't just reflected in market declines. Trading activity actually hit record levels. On April 4th alone, we witnessed the highest ever single-day options trading volume, with investors exchanging an unprecedented 101 million contracts. And it was clear that the uncertainty around global trade, it was sending shockwaves through investor sentiment, no doubt about it. But behind these dramatic moves, there were sharp contrasts between sectors. You saw it, technology stocks, notably insulated from the tariff disruptions, they thrived for companies like Microsoft and Netflix, whose stock prices actually reached all-time highs. Conversely, tariff-sensitive industries, they faced significant headwinds. Now, as you can see here, yet the markets proved again how quickly fear can turn into optimism, because a partial tariff pause was announced shortly thereafter. And investors, they breathed a collective sigh of relief. And on April 9th, just days after the steep decline that we had seen, the S&P 500 rebounded dramatically, surging nearly 10% in a day. That was the third biggest one-day gain for the S&P 500 since 1950. This remarkable turnaround kickstarted an extraordinary 9-day winning streak for the index. It's actually the longest we've seen in over 20 years. So let's look at Ryan's market fact for some historic statistics around this historic event. So we're calling this, Ryan Market Fact, the S&P 500's historic 9-day rally. And if you look at it, the total gain, the index surged approximately 10.2% during this period, effectively erasing the losses incurred from early April's tariff-induced downturn. Compared to other 9-day streaks, this ranked number 1 in total return during that period. Unbelievable. Let's give you some historical context here. Such extended rallies, they are very rare. And this marks only the 28th instance since 1954 where the S&P 500 has risen for 9 consecutive days. Now, what does this tell us about future performance? I mean, historically, we can look at it. And after market streaks like the one that we've just experienced, if you look at history, the S&P 500 has gone on to deliver positive returns 80% of the time over the following year, averaging gains of about 13%. By May 5th, the market had fully recovered from its earlier losses, finishing the streak with a gain of more than 10%. Now, let's look at the total returns since Liberation Day, or the tariff announcement, from April 2nd to May 12th. And if you look at it, the NASDAQ, from the beginning of that period, remember when they announced it, to where we are as of May 12th, NASDAQ up 6%. International developed stocks up 5%. Emerging markets up 4%. Gold up 3%. S&P 500 up 3%. Bonds, the US dollar, and crude oil, the only ones that are down. Crude oil actually down about 13% from that announcement. Now it's official. As of this past Monday, May 12th, the S&P 500 has closed more than 20% above its April low, technically beginning a new bull market, up over 1,000 points in 1 month. So what's insane is if you look at this, we basically went from a bull market to a bear market, back to a bull market in about a month. That's crazy. So what can we learn from this April roller coaster? First, volatility, while uncomfortable, it's a part of investing. Markets rarely move in a straight line, and they respond to shifting expectations, not just news itself. And this is precisely why last month's Let's Talk Markets, we focused entirely on putting volatility into perspective, highlighting how historical evidence consistently underscores the importance of remaining invested during uncertain periods. Because April reminded us, moments of panic often lead to moments of opportunity, especially for long-term investors. Okay, so that was April. Now let's look at the road ahead, and I'm going to focus on 3 key points here: policy, the economy, and expectations. And as we look forward, it's essential to identify key factors that will shape our investment decisions and market outlook. So here are the critical areas investors should monitor closely through the rest of 2025. First, Federal Reserve, pausing rates and economic stability. And so you can see from this graph here, in early May, the Fed maintained interest rates steady, keeping them at the range of 4.25% to 4.5%. This move signals even greater patience from the Fed. Now, as they closely monitor inflation, which has significantly eased from previous highs, but still sits slightly above the Fed's 2% target. Actually, the most recent report of CPI, it came in at 2.3%, well below expectations, and the lowest reading, you ready for this, in 4 years. The Fed's recent decision to pause rate hikes has sparked a ton of debate. Despite falling inflation and robust employment figures, this cautious stance indicates the Fed remains vigilant. Market predictions, they vary widely, right? From optimistic expectations of up to 4 rate cuts this year to more conservative forecasts, with some analysts even suggesting additional rate hikes are possible. Now, at Beavers Wealth Management, we anticipate, as we have been, a higher for longer interest rate environment. We believe the Fed will wait for unequivocal evidence that inflationary risks have dissipated before initiating rate cuts, tempering some of the market's more optimistic expectations. Now, it's also worth noting, historically, periods following Fed rate pauses, they've been favorable for markets. In fact, following the last 6 rate pause cycles, the S&P 500 has typically rallied, averaging nearly 17% returns in the subsequent year. Investors should pay close attention to the Fed's future decisions on interest rates, as this will remain a pivotal and closely watched issue. Remember, historically, 2 primary drivers underpin long-term market performance, and we've talked about this before. It's interest rates and it's corporate earnings. All right, so let's talk about the second one, jobs and earnings. As you can see here, the labor market continues to offer further reassurance. April saw another strong employment report with the addition of 177,000 new jobs. That was well above the 130,000 jobs expected. And this marked an impressive 52 consecutive months of job gains. And this streak, it's historically significant, as you can see, ranking as the second longest sustained period of job creation ever recorded, underscoring remarkable employment stability and confidence among consumers. And you know what? Corporate earnings, they've been surprisingly resilient. Over half of the companies within the S&P 500, they've reported results for the first quarter, and nearly 76% of them have exceeded analyst expectations. As you can see, earnings growth near 9% year over year. Profit margins have also hit their highest levels since 2021. Current profit margins, they hover around 12.4%. This is pretty good. This is really good. And this demonstrates impressive resilience amongst companies, reflecting their ability to effectively manage significant challenges, such as inflation and trade disruptions, while achieving historically strong profitability. Remember, strong earnings and healthy employment are reliable indicators of underlying economic stability. So let's talk about that. Our next point, economic signals and recession fears. Turning to economic growth, headlines in April sparked some recession fears, right? Because we heard the news of a modest GDP contraction of negative 0.3%, which you can see. Now, this contraction was largely driven by a temporary surge in imports because businesses were anticipating the tariff increases. But this headline number, it didn't tell the full story. Removing this volatility, core GDP, which measures the fundamental strength of the economy, actually rose a robust 3.1%. And this underlying growth, it indicates a fundamentally resilient economy. So really, simply put, headlines can mislead. Underneath the noise, the economy remains fundamentally healthy. And I'll highlight one more point too. Let's talk a little bit about Trump's economic agenda and really what it means for you. So finally, it's important to understand how policy will shape market sentiment going forward. Because President Trump's economic approach is centered on three main pillars: tariffs, deregulation, and tax reform. As for tariffs, as I've mentioned at the beginning of today's discussion, recent tariff negotiations, notably with the UK, which we saw, show promising progress, suggesting potential stability ahead. History shows that easing trade tensions often spark significant market rallies. What about deregulation? Well, efforts to reduce regulatory burdens in energy, finance, and technology sectors, they could unlock profitability and stimulate business growth. And then finally, corporate tax cuts, right? Proposals extending the 2017 tax reforms, they are likely coming this summer, potentially enhancing corporate earnings, fueling investment, and positively impacting market valuations. Taken together, these policies, if effectively implemented, could foster robust growth, creating an optimistic outlook for investors in the long term. And so what's the bottom line? Maintaining perspective is your greatest asset. Times like these emphasize the value of having a clear, long-term investment plan and then sticking with it. I mean, like Ryan said in his market fact last month, there's no upside with occasional downside. There's no reward without risk. And as markets have taken a much-needed breath in the past few weeks, it's important to not get carried away or overly euphoric. Just as you can overreact in down markets, you can equally overreact in up markets. And while we're cautious in the short term, we are absolutely bullish on the markets long term. And we have good reasons for it. Times like these remind us of the importance of stepping back, ignoring reactionary moves triggered by daily headlines, and most importantly, having a solid plan in place. At Beavers Wealth Management, we don't just talk about plans. We proactively implement them every single day. Our job is to anticipate, not react, continually evaluating risks and opportunities to ensure you're positioned to not only navigate this volatility, but then capitalize on it. Ultimately, we're here to give you confidence and clarity, knowing that you're not alone to navigate the market's inherent unpredictability. And as we've seen recently, market volatility can create significant uncertainty. And the people you care about may be feeling unsettled about their financial future. So if you have a friend, a family member, or even a colleague who could benefit from a trusted second set of eyes on their investment, now is the perfect time to introduce them to our Second Opinion service. We created this service so that anyone can come to us with their current investments or their financial plan or strategy and gain a fresh perspective, ensuring their investments align with their unique goals, and then provide the reassurance that they're on track. And so if someone you know could benefit from this clarity, we encourage you to reach out to us anytime. We'd be honored to help. We are so grateful you joined us today, and we encourage you to share this content with anyone you might find valuable. And if you have the replays, all of the Let's Talk Markets, they're posted on our new YouTube page, and the video podcast format is on Spotify so that you can see all the graphs as well. And YouTube and Spotify, they're also home to episodes of our podcast, Between the Bears and the Bulls. And we've released a few new episodes this year. You got to check out the one with Ryan and his mom here this past week. It's a good one. So if you have any suggestions on what you'd like to see from us, please let us know. We want to make sure the content we put out there is valuable for you. Oh, and one last thing before you go. I've been getting a lot of questions about when does it become a dad joke? And it's quite simple, really. It's when it becomes apparent. We'll see you next month for June editions of Let's Talk Markets. And don't forget, leave it to Beavers.